Welcome to the debate. Today we are focusing on Adobe, which is, for years, it's been one of the most structurally dominant players in the SaaS world. It's really been the definition of a high-quality compounder, thanks to its best-in-class subscription model and just astonishingly high operating margins. But today, that status is under intense scrutiny. The market seems unsettled by the rapid emergence of generative AI, fierce niche competition, and, some persistent skepticism around its underlying financial structure.
Indeed. And the stakes for long-term investors are, frankly, existential. So the central question we really have to answer is this. Is Adobe's entrenched ecosystem, which is built on proprietary data and a so far successful integration of AI, is that a durable acceleration moat that justifies its premium valuation? Or does the rising threat of market fragmentation and this underlying financial reliance on stock-based compensation, SBC, does that expose the core business to unavoidable margin erosion and competitive disruption?
Well, I'm going to argue that Adobe is not just surviving the AI transition, but is actively capitalizing on its incumbent position to reinforce its moat, capture new market share, and monetize AI as a core feature.
And I come at it from a different angle. I'll argue that critical competitive threats and, certain financial accounting practices fundamentally undermine Adobe's long-term status. I think the true profitability and durability of the business are far lower than the conventional metrics might suggest.
Okay. Well, Adobe is an unparalleled market leader, and we just need to look at the foundational financial and competitive facts. Over 90% of their revenue is highly predictable recurring subscription revenue. They maintain robust profitability, evidenced by a non-GAAP operating margin of nearly, 47% in the last fiscal year. This financial strength isn't an accident. It's built on a staggering competitive advantage, high consumer stickiness, strong pricing power, and critically, a deeply integrated workflow system. Adobe holds over 80% share of the global graphics processing software market. More fundamentally, Adobe is, I think, uniquely positioned to dominate the Gen AI opportunity. We have the data to prove it. Their proprietary model, Firefly, has generated assets well into the billions since launch, and management reports that AI already influences approximately $5 billion of Adobe's annual revenue through improved retention and pricing uplift. The strategy is straightforward. AI enhances the professional workflow, particularly in Creative Cloud, and it dramatically expands the total addressable market in high-value enterprise sectors via the Document Cloud.
Right, and I see why you think that, but let me give you a different perspective, one that the market itself has started to validate. The perception of dominance is under critical threat, and, more importantly, the true profitability of this company is arguably lower than advertised. When the market fears competitive disruption, as we saw with the stock drop amid AI competition concerns, it's signaling legitimate structural risk. The competition is no longer just niche, it is successfully segmenting and capturing massive new markets. Consider Canva. It holds a respectable 10% share of the graphics software market, but its true threat is its focus on the massive communicators market, an estimated 900 million users who just don't need the complexity of Photoshop. Canva's free-to-paid conversion rate, even if you project it modestly at 10%, represents massive, profitable market capture outside of Adobe's core.
That's an interesting framing of the competitive landscape.
And furthermore, the financial optics are challenged by the aggressive use of stock-based compensation, or SBC. Now, SBC is compensation paid in shares instead of cash, which, it increases operating margin on paper, but it effectively dilutes long-term shareholder value. When you adjust the conventional free cash flow calculation by deducting SBC, the valuation multiple jumps significantly, from around 26 times FCF to over 34 times FCF for the next fiscal year. This 30% difference in valuation fundamentally questions whether the premium afforded to Adobe as a quality compounder is truly warranted given the true cost of retaining its top-tier talent. The combined risks of market fragmentation and these hidden financial costs make the business far more fragile than the headline numbers suggest.
Okay, let's start with that competitive dynamic and the durability of the economic moat. While I acknowledge the rise of Canva and Figma, Their success resides almost entirely outside the mission-critical, high-stakes professional production pipeline. The high switching costs and network effects within the professional sphere remain, I would argue, very secure. The crucial element here is the deeply embedded interoperability tax. The seamless transition required between Photoshop for imaging, Illustrator for vector graphics, and Premiere for video, all using native Adobe file formats, is simply indispensable for agencies, film studios, and large corporate marketing teams.
That's a strong point regarding the interoperability within the Creative Cloud suite. It is, and furthermore, the distribution leverage locks in customers. Think of print vendors, large publishers, or highly regulated enterprise marketing departments. They demand specific, industry-standard file outputs like specific PDF formats or print-ready files that competitors like Canva or even Affinity simply cannot reliably produce or integrate into their key workflows. This proprietary end-to-end integration creates a massive defensible distribution channel that competitors cannot easily replicate. Canva captures the amateur and small business market, sure, but that 80% share of the core professional graphics market is sticky and high margin, and it forms a virtuous cycle of improvement. That's a compelling argument, but I would frame the competitive threat differently. The competition doesn't need to replace the core professional segment instantly. They simply need to capture growth in adjacent, rapidly expanding markets, shrinking the moat at its edges, which is where the future revenue resides. Figma dominated the browser-based UI/UX design niche, and now Canva is dominating the non-professional communicator space. By ignoring or, let's say, downplaying the importance of these adjacent markets, Adobe risks ceding future market leadership. The moat is becoming irrelevant to a growing segment of content creators. The rise of good enough AI tools allows this huge segment of non-professional communicators to bypass the traditional, complex Creative Cloud workflow entirely. I mean, why pay $50 a month for the full suite when an accessible AI tool can generate 80% of what you need quickly and cheaply?
Many industries, not just Adobe. But let's turn to the core AI thesis itself, because this is where Adobe shows a real competitive strength and monetization capability, particularly in the Document Cloud segment, which targets high-value enterprise contracts. Generative AI is a proven tailwind driving quantifiable efficiency gains.
I'm waiting to see how this translates to long-term pricing power.
It translates through enterprise value capture. Consider the Document Cloud's AI assistant. We are talking about dramatic, quantifiable time savings for highly paid knowledge workers. For a financial analyst tasked with preparing a briefing on a corporate earnings report, a task that previously required, 2 hours of synthesis and presentation creation, the AI assistant can condense that down to under 41 minutes. That kind of productivity gain it's revolutionary. Forrester projected up to a 415% 3-year projected ROI for organizations using AI assistant for complex document tasks. This expands Adobe's penetration into high-value professional sectors, legal, finance, HR, where the demand is for mission-critical reliability, not just aesthetic quality. CEO Shantanu Narayan emphasizes that Firefly is integrated as a co-pilot to enhance existing workflows, reinforcing the value proposition, not disrupting it. This is Adobe driving demonstrable enterprise-level revenue and efficiency gains today.
I'm not convinced by that line of reasoning, because the legal and ethical foundation underpinning that AI revenue stream is shaky, and it introduces a critical systemic risk around customer trust. Widespread industry lawsuits against peers over copyrighted training data, we're talking about massive class action suits, create immense regulatory and legal uncertainty, which Adobe is certainly not immune to. But more immediately concerning is the risk to enterprise trust. Adobe faced a significant backlash recently over updates to its terms of service, which suggested the company may access and analyze user content, including proprietary and confidential enterprise documents, to train its machine learning models.
But they clarify that. They clarify that they only use content that users explicitly submit for training, and they have strict measures for enterprise clients.
That clarification only came after intense backlash. For high-stakes enterprise clients, legal firms, government contractors, finance organizations handling sensitive M&A documents, the mere suggestion of data mining risk is an existential threat. These clients prioritize confidentiality and data sovereignty above all else, even efficiency. If they cannot trust that their highly confidential files won't be used to train a public AI model, they will shift their workflow entirely, regardless of how efficient the Document Cloud AI assistant is. And if AI commoditizes content creation by lowering the barrier to entry, the long-term pricing power for the highly profitable core Creative Cloud suite faces a structural decline, which is a far greater financial threat than the Document Cloud gains can offset.
All right, let's pivot to the financial quality then, because you've highlighted the use of stock-based compensation as a central point of weakness. While the PF-CF multiple adjustment is numerically accurate, focusing solely on SBC ignores the overall financial picture. Adobe's built on robust operating leverage, projected to drive substantial non-GAAP net income growth of 11 to 13% year over year through FY26E. Adobe's financial profile consistently exhibits the highest free cash flow margin, combined with revenue CAGR compared to almost every comparable SaaS platform.
I understand the operational strength, but you cannot discuss long-term durability without addressing the quality of those earnings. The fact that SBC resulted in such a massive variance in free cash flow per share, over $4 per share in FY24, demonstrates that the commonly cited profitability metrics are materially inflated. And let's just define this clearly. Non-GAAP metrics exclude SBC, making the stated operating margins appear robust.
And this is done across the entire tech sector to account for the competitive nature of talent acquisition.
That may be true, but it doesn't change the economic reality for shareholders. When Adobe uses cash to aggressively repurchase shares, reducing the share count by about 10% over the last 7 years, they are effectively running on a treadmill. They buy back shares with cash to offset the immediate dilution caused by issuing those very same shares at lower values to employees as compensation. This practice is a material transfer of capital to employees. It means the cash that could have been returned to long-term shareholders or reinvested is instead being used to manage dilution caused by the high cost of retaining talent. This expense must be treated as a true operational cost when assessing the long-term cash generation of a supposed compounder. That 34 times multiple reflects the true cost of operations, and it makes the stock look significantly more expensive than its peers.
But that capital allocation strategy is essential to maintaining its competitive edge. They have to secure the best engineers and AI researchers to maintain that 80% market share and execute the AI strategy. The question isn't whether SBC is expensive. It is. The question is whether the revenue growth and operating leverage that this high-cost talent drives justifies the expense. Given the massive cash flow generation capability, which far outstrips their capital expenditures, I argue that the expense is warranted and manageable. Furthermore, their ability to increase pricing power across Creative Cloud licenses proves the value of the platform remains intact.
Pricing power may be intact for now, but that is the precise risk, the erosion of that power. If the underlying asset, the highly specialized workflow knowledge, is commoditized by AI, then that pricing power collapses. The high cost of talent from SPC, combined with the erosion of the competitive differentiation from AI, lowering the bar, well, it creates a deeply fragile profit structure for the future.
Ultimately, I believe Adobe possesses the requisite assets: a highly sticky, high-margin subscription base, a massive professional distribution channel, and proprietary, commercially safe AI models like Firefly and AI Assistant to successfully navigate this transition. The successful integration of AI into established mission-critical workflows is what defines the new acceleration moat, ensuring sustained growth as a high-quality compounder. The narrative here is about leveraging their established position to embed AI as an indispensable feature, not as a replacement.
We agree on the strength of the subscription revenue model, but we fundamentally diverge on the durability of the moat and the true quality of those earnings. The evidence suggests that while Adobe is innovating, it is doing so at a steep and often obscured cost, the stock-based compensation, and against rapidly evolving existential threats from dedicated AI players and expanding adjacent platforms like Canva and Figma. The fundamental risk is that AI reduces the value of the best-in-class creative workflow, making Adobe's high financial metrics potentially fragile over the long term and demanding a much more conservative valuation multiple.
The debate ultimately hinges on a question of pace.
whether Adobe's powerful incumbent advantage provides enough runway to monetize AI effectively before market fragmentation and competitive pressures fundamentally erode the core business profitability.
Leaving the investor to weigh the undeniable scale and operational strength against the hidden costs of operations and the systemic risk to crucial customer trust in the age of generative AI. Thank you for the exchange.